I was asked to do a second introduction of myself. I'm the COO of Gnosis. My name is Friederike Ernst. I'm also the General Secretary of the Blockchain Bundesverband here in Berlin. I am going to talk about Gnosis. Gnosis is a platform for prediction markets, and gauging the room, I wouldn't be surprised if many of you had never heard the term prediction market. So I'm going to give an introduction to prediction markets, and hopefully in the end you guys will understand what we're encompassing to do. Prediction markets are the coolest thing you have never heard of, by the way. Okay, so what is a prediction market? It's a really general thing. So for a prediction market, you need an event in the future that ideally has more than one outcome. And that outcome should also be knowable after the fact. So you don't want something where you can't actually know what has happened. Then you need to have people who are actually interested in this and who have some sort of prediction as to what may happen. They should also have some sort of disposable funds that they can put in the market. And what you get out is a forecast. And it has been game theoretically shown that this is actually the best forecast that you can arrive at. As a buy thing, you also, the participants who predicted the correct outcome, they also get financially rewarded. So there is an intrinsic motivation for people who actually have good information to share that on these prediction markets. Okay, so you now know what in principle it should be able to do. How does it work? So it's going to be a little bit more technical than the last talk, but I'll walk you through it really slowly, and it's everyone here can understand this. So you start with a collateral token. Here it's made out to be an ether. It could be anything. It could be a Bitcoin, it could be a stable coin. Anything that works on a blockchain will work. Then you have a categorical event, something like who is going to win the World Cup 2018, and then you have a set of outcomes. So these outcomes, they should cover all possibilities. So in the case of a World Cup, how many participants are there in a World Cup? Does anyone know? 32. So you would actually have 32 outcome tokens here. So the alphabet wouldn't be quite enough, but you would be absolutely certain that one of these would actually take the cup home. And these three you get for one, these 3 or 32 you get for buying, you can buy for one collateral token. And at any point in time, you can actually sell these 3 for the same categorical event, regardless of whether it's happened yet or not, and you will get your collateral token back. Okay, so this seems pointless. The real trick is that you can actually trade these outcome tokens between buying and selling them again. So the idea is that here you have these outcome tokens, and for example in the World Cup, about half of the teams is eliminated after the group stage. So these outcome tokens, they will be worth 0 because they won't be able to take home the cup anymore, right? So the other outcome tokens, they will have risen in value. So actually, if you bought all outcome tokens and then sold the ones that you didn't want, you make what the current probability of these is at that point, and then you can sell the other ones later. And for the ones, and basically for other ones that are 0 in the end, you don't actually need to replace them. So here in the end, you actually get the full collateral token for the one outcome token that has been resolved to be the winner. Okay, I think I'm failing with the mic here. Can you all hear me? Cool, fantastic. Okay, so how does it work? So this is the same thing again. So here you have your collateral token that you put in. It goes into an event contract. The event contract actually issues these collateral tokens. And then with a market contract, you can actually interact with these collateral tokens and buy and sell them. And in this process, over time, they will change in value. So for instance, if you have the US primaries These are all the Republican primary candidates. So you have Carr, Cruz, Rubio, Trump, and none of the above. And we all know what happened. But in the process, you can actually see how the probabilities of these different people, how they fluctuated. So in the beginning, it actually looked at some point like Rubio was going to win, so he had a probability of way over 60%. And then at some point, Trump took over, and then here he took a dive, and Cruz and none of the above, they actually went up, and then, yeah, you all know how this turned out. So ideally, all these tokens would add up to 1, otherwise they are arbitrage possibilities, and markets don't usually like letting that happen. And then what happens when the event actually occurs is, we had this question earlier, how do you actually get this on the blockchain? How does the blockchain know whether, who of these people actually became who became the winner of these primary elections? And I answered this shortly earlier. So this is what we call an oracle here. So the event contract actually asks a pre-specified oracle what has happened in the real world. So this could be something that's off-chain, like a data feed that's signed. It could also be a consortium of, say 4 or 5 people. So you have 5 experts that actually sign contracts saying who actually won. And if 4 of those 5 agree, then this is paid out. You could also have something that's on-chain. So sometimes it could be whether a transaction has happened on-chain or not. These are all options. We at Gnosis, we are oracle agnostic, so you can bring your own oracle. You can decide which oracle you want to use. Okay, so now we understand this. So you have all these different outcomes. They are represented by outcome tokens. The outcome tokens, they change in value depending on the probability of that candidate winning at that point in time. That's easy enough, right? You guys, questions? No, cool. Fantastic. We can do the same thing for scalar events. Scalar events are what we call, for instance, the stock price of a certain share. So for instance, Apple trades today at $160. So you could actually have a prediction market on the price of an Apple share. You have to set a lower bound and an upper bound. Say for the next week, it'll be between $100 and $200. It's not going to go, it's very unlikely to go below or above that. And then you issue 2 tokens. So here you put in your collateral token again. Here is the scalar event is the price of the Apple stock next week. You get a short token and a long token. The short token from here says from here on out it's going to increase. It's going to decrease in value. The long token says it's going to increase in value. Same as earlier, if you have these 2 tokens together again, you can buy. You can sell them for 1 collateral token. So as earlier, you can actually trade the market in real time. You don't actually have to wait it out until the end of this market. You can sell at any time in between. So for instance, if you know there's going to be good news for Apple because you happen to know that they sold more iPads than last quarter, you would buy these 2 tokens. You sell the short token, you keep the long token. The long token then increases in value. You rebuy the short token at a lower price, and then you sell both of them for the Ether, and you made a net profit. Okay, so this is how prediction market. Yes.
Do we always have to have all tokens to sell them, or can I sell single tokens?
Yeah. So on the market, you can trade single tokens against. So basically, these are fully tradable. They are ERC20 tokens. So you can trade them either with the market contract that we provide, or you could trade them on exchanges. But if you want to interact with the event contract and get the Ether you put in back, you actually have to buy all the other outcomes and then sell them. But on the market, you can sell individual outcomes as well.
So, talking about the soccer example, I sell some clubs which I don't believe they win within the system.
Exactly.
And when they really dropped out, I get the tokens back for low because they are worthless and
Exactly.
then I can sell it? Okay.
Exactly. So basically, you don't actually have to buy the token of the club that you think will win. You have to buy, so you should, economically, you should buy the token of the club that you think is undervalued. So for instance, if you think in the Bundesliga, the chances of Bayern Munich of winning the next championship are less than 95%, and the chances of Borussia Dortmund are more than 5%, but that's exactly what the market thinks. You should go short on Bayern Munich and long on Borussia, despite the fact that you think it's likely that Bayern will still win.
Yeah, just betting the secondary.
Yes, exactly.
Yeah,
Okay, cool. So this is the value of the short and the long token. So basically, I told you need to set a lower bound and an upper bound, and then they are worth exactly what the Y value corresponds here on this the scale. So basically, on the lower bound, the long token is worth 0. On the upper bound, it's worth 1. And converse for the short token, so they always add up to 1, just like all the other categorical outcome tokens that we talked about earlier. Everyone who's ever played the stock market knows this very well, and it's yeah, I can hear Connie there. Okay. Oops. So now the question is, why do you actually want to do this on the blockchain? I mean, prediction markets have been a thing for 25 years. People have pushed them continuously because it makes economic sense that they would give you the best one forecast that you could get on any one number. Why do you want to do it on Ethereum? Well, first of all, it's trustless. You don't have counterparty risk, but you also don't actually have to trust the prediction market provider, because all the funds are in smart contracts. So the smart contracts, they are reviewed, they are audited multiple times. So we don't ever actually have your funds. They just lie in smart contracts. It's censorship resistant. So once your transaction has been sent to the blockchain, we heard earlier that it can't be changed, and it also can't be censored. By creating one permissionless platform for all, you actually increase the efficiency of the system. So for instance, what does that mean? For instance, when you call a taxi, for instance, I have several apps for taxis on my phone. So I have the Uber app and the Lyft app and the My Taxi app. You have that here in Hamburg too, right? Cool, fantastic. And when I actually tap these, I don't actually care who comes and picks me up. I just want some car to come and pick me up, right? So I don't care whether it's an Uber or a Lyft driver. And for me as a customer, it would be much better they all operated on the same platform, and just the closest car to me would be sent to me. This usually doesn't happen because, for instance, if Uber were to say, we're creating this platform for everyone, why don't all of you come on our platform? The others would say, well, but it's your platform, you make the rules. This is not true for blockchain. So for blockchain, you know what the rules are ahead of time before you commit to them, and no one can change them. Or you can only change them with consensus. So this increases efficiency because, for instance, now when you have, for instance, one of the applications of this is insurance. So now you have different insurance companies, and they give different rates. And this speaks to the fact that somehow the market is inefficient there. And this can be avoided with using blockchain technology. And then when you combine all your liquidity, you lower your fees. Okay, so what applications can be built? Let me just check how I'm doing on time. Oh, cool, fantastic. Okay, so prediction markets, it seems like a really trivial concept, but actually a lot of very common business models can be fully mapped onto this simple transaction that I showed you earlier. So you can use it to buy and sell information, to do forecasting. So for instance, if you are an art auction house, say you're Sotheby's, you give out guarantees to people who sell their art on your platform. So for instance, if I had a Picasso that I was going to sell, I would go to several auction houses and ask them what the guaranteed price on this Picasso would be at their auction house. And they would say, for instance, this is worth $75 million, or whatever. I don't know what people pay for Picassos these days. And then if the piece actually catches less than that, they are liable for the shortfall. So they are interested in giving you a price that is not lower than what is actually going to fetch in the end. They are also interested in giving you a price that is as high as possible, because other auction houses are doing the same thing, and they take home 6% of the profit, right? So you want to have it. You want to have a price that's appropriate, but not too high. Okay, so basically, how would you go about this? You would have a prediction market asking what is the value of the Mona Lisa, and you would fund it initially, and then the art experts in the world who know who is looking for the Mona Lisa or Picassos to buy, and they would input their information. And because they are economically incentivized to put in the best information that they have, because if they actually make the forecast better, in the end, they actually take home money. If they make the forecast worse, they lose money, okay? So it depends on how certain you are that your information is good, and you have to back it by money. Something else you could do is, for instance, you all know the story of the Berlin airport, right? Yeah? Okay, so for the non-Germans here, so basically the Berlin airport was set to open 4 years ago in March. 2 weeks ahead of the opening ceremony, they blew it off. So they said, this is not going to open because it's not done. So other shops had been stocked. The snacks for the ceremony had been ordered. People had been put on a payroll to staff the security lines and everything. It was a complete disaster. It's still not open, by the way. So how could that happen? Did no one know that it wasn't ready? Of course someone knew. Of course someone knew the information was there somewhere, just had no way of getting to the surface. So if I had been the Land Berlin-Brandenburg who was building this airport, I would have wanted to know. I mean, this was a complete PR disaster, and there was a whole host of costs associated with this. Well, for one, you become a public laughingstock, but also you lose a lot of money if the airport doesn't open. So if they had actually had a prediction market like that, and they had funded it with, say, $20,000, then anyone who would have known that it's not going to open at that date could have just bought down those $20,000. And if you are, a month ahead of the opening date, and the probability of the airport opening, according to the prediction market, is actually 20%, you go looking for what's going wrong, and you have. And ideally, you have this prediction market in the years running up to the opening, so you can actually track in real time when the people who are actually involved in the project, when they think it's going awry. You want to know. You can also use that for internal company forecasting of when your projects are going to end. So you just ask your staff, are we going to get this done by then? And because they have a financial incentive to trade this market, often you're reluctant to tell your boss that it's not going to happen. You think, you don't want to be the bearer of bad news. But here, no one really is the bearer of bad news because it's anonymous, ideally. Okay, so this is buying and selling information. Then the second point is insurance and hedging. So, for instance, will my house burn down? In our eyes, that's a question for a prediction market. So, in essence, in the terms I outlined earlier, it's a bet in that you put in money. If it's a bet on your house burning down, in essence. So, if your house burns down, you net the profit. Sadly, if your house doesn't burn down, your money is gone. That's a bet. That's exactly the system of a bet.
Sorry?
Yes?
I have a question for, will my house burn down? Let's say my house is worth $100,000 and the prediction market is worth $200,000.
So if the price of the prediction market is higher than the actual asset or event, there's a huge incentive to manipulate the market.
Yes, absolutely. But you always need a counterparty, right? So no one should be willing to take that as a counterparty. No one should be willing to bet the other side. And I see your point. So there are actually some problems with this. So I should be able to bet on my own house burning down. I absolutely should not be allowed to bet on your house burning down, because then I actually get paid when your house gets burned down. And this is somehow, this does not seem right. So so with insurance, this is basically what happened with credit default swaps. So basically, you want to make sure that the person who is actually incurring the loss, that they're insured, and this is the case with traditional banking as well. So yeah. Okay, so insurance. Then going back to traditional banking. So basically, stocks. They are a bet on, so options are a bet on stocks going up and down. So many financial market products are actually mappable onto this. Then incentivizing. You could incentivize your flatmate to clean the dishes by having a prediction market. I bet the dishes are not going to be done tomorrow morning. And you put in €5, they might just do it, just for the €5 that are involved. So this is incentivizing. It also works at a larger scale. So, for instance, you could incentivize a country such as Japan to build more nuclear power plants, or more solar panels, or more wind stations. Okay, so this is also, I have said bet a lot, I guess. So this also applies to gambling. So who will win the World Cup next year is also a prime example of this. And the last and most, in my eyes, one of the most exciting parts is the governance and decision-making mechanism that can be implemented with this. It's called Futaki, and Maria just talked about it very shortly, or she mentioned it at least. It gives you a tool to actually decide what decision you should make as a society, or as a company, or as a group of people. What you need to do is you need to define a metric that you would like to optimize. So I'm giving you a very corporate example, but it goes for almost everything. Okay, so these are just examples of predicting information. So basically, this is just what are the earnings per share for some sort of stock? What's the value of a painting? That's for flight insurance. Okay, so that's the governance and decision making. So you want to define some sort of metric. A metric could be the revenue of a company at time X. So you have two prediction markets. One is conditional on CEO A being hired. That's the dark green line here. And one is conditional on CEO B being hired. And what this is forecasting is the revenue at time X. So this is time X. It's a time in the future. And you need to decide which CEO you're going to hire before that time X. So here's decision time. And what happens here is you just look at what happened in a given interval before this decision time. So CEO B or CEO A, did they do better? And here it turns out CEO B did better, so she gets hired. So everything that happened here until here with here for CEO A, everyone who had tokens conditional on CEO A becoming CEO, they just get their tokens refunded, because this was counterfactual and this didn't actually happen, so they just get back all the money they put in. And for everyone who bought the tokens for CEO B, they just continue as a normal prediction market, and then they go up and down, and you have long and short shares again. And then you, at time X, you either stand to lose or make money, depending on how much you actually paid for your shares at the time. So you can see this graph. This is just over the time what the forecast of the revenue given CEO B was over time. So here is at the time when she actually became CEO. And just as in any prediction market, you actually have losers and winners, so everyone who bought in the time periods that are marked in pink here, they all made money. Everyone who bought in those gray timescales, they lost a little bit of money. So, and in the end, this prediction market gets resolved, so we know what the actual value is at time X, and then all the payouts are made. So this is not a magical tool. So you still need to set the thing you're actually optimizing for. So this does not need to be revenue. This could also be something, but typically things that you want to optimize, they're difficult to measure. So it's things like how happy are people or something. This is very difficult to measure. This is why people always use examples that you can put numbers on really easily. So this is why we use this revenue example. But you could also, I mean, there are countries that actually measure the happiness of their people, and you want to implement policies that will increase the average happiness of your people. Yes?
Is there actually a time value that goes down?
Is there what?
A time value that goes down, like there are races where you have like the closer you get to the actual point of time where the bet runs out, like X, the less worth it is, obviously, because like it's less likely that changes will be very big from there.
Well, because you always pay the value at that time when you're buying. So if you're buying a couple of days before the decision, and it's 95% sure that candidate A is going to win, then you you get 2 shares for your collateral token. One that's worth 0.95, that's for the likely candidate, and one that's worth 0.5. And then you can, if your money is on the likely candidate, you sell the candidate that's less likely, so you sell the 0.5. And if the other candidate wins, then you make 0.5. If your candidate loses, you lose 0.95. So basically, it's just always the market probability. Yes.
Yeah, I just wanted to get it right. Is this a kind of a high-tech betting?
Yes. So basically, it completely encompasses betting, but it also encompasses a lot of other business models. So betting is a complete subset of this. Absolutely. Typically with betting, the connotation in my head is that you don't know what the outcome is going to be, and you can't know. So basically in betting, it's considered cheating if you see one of the players at the doctors beforehand and you bet against that team. So basically the difference between stock trading and betting is, in my eyes, that people perceive it as either a game of skill or not a game of skill. So basically betting on football teams, people would generally see as a form of entertainment. Yes?
You run this thing on Aetherium. Is the transaction cost, how expensive is it?
It's prohibitive. So at the moment it's prohibitive. So the only systems that we can actually run at the moment are those information surfacing systems. So everything else that requires a high trading volume, it's not doable at the moment, which is also why we're working on a decentralized exchange and why we're working on scaling mechanisms. Yes? Here?
In kind of real time terms, how far away are we from a company buying software with that sort of interface and making it work on a day-to-day basis?
So off-chain, you can buy this. There are companies that provide these services to you.
That comprehensively,
the Futaki example. I'm not sure whether people actually do Futaki. I would be surprised if they don't, because there are companies that provide prediction market services that you can use in your own company. Yes?
This is technologically very interesting, but more interesting is the regulatory aspect, as we already found out. What steps is Gnosis or also the Bundesblock taking to make this useful for the ordinary person or me as a developer in the future?
Okay, so basically these are 2 separate questions. So the Bundesblock, they are very heavily behind getting things like these regulated and coming out with clear legislation that actually lets you know the terms. We as Gnosis, obviously, so we're spending way too many of our resources on legal expertise. So we're trying to take care of this. It's very difficult because the frames in which we work, they are still uncertain. Yes, in the back?
Question, how do you get liquidity on number of trades that you have? Because it's quite clear for the World Cup, because it's a whole gambling industry that you are basically taking. But for the case of whether the dishes would be washed tomorrow, or even the CEO is elected, or even for Mona Lisa pricing, there is a very low liquidity. And in that case, the second question, for the cases of low liquidity, how do you solve the uneven distribution of information problem? Because for the low liquidity, there will be experts who know, and just 1 or 2 persons who would bet against it. So the expert would always win.
Exactly. So basically the way we see it is afterwards the crowd would always be wiser. So basically you're paying for the wisdom. So you're paying for the wisdom of the experts. So for markets with low liquidity, there are 2 answers. So either these are markets that one person can conclusively resolve. So in the case of the dishes, your flatmate, they can actually take care of this, right? So if they know they're going to do the dishes, that's enough for the incentivization for them to actually bet against it. They take the $5, they do the dishes, they get the $5. So for other things where there's low liquidity, so basically if you're the person who wants to gain that information, so for instance you are the company that is building the airport, you want to know whether it's happening or not, whether somehow there's siloed information within your company structure, it's in your best interest to put up an initial funding, and we provide a smart contract that actually always bets against the people who are willing to take bets in the beginning, so that you actually get some liquidity. We call that an automated market maker. So we have ways to go about this. But it's true, so basically the spreads are smaller on markets that are more liquid. Yes?
Especially about the airport example, but if the crowd is betting, yeah, of course the airport will be open at that time, and I have a really small amount of experts who know the truth, I will not figure out the truth when I will be Brandenburg and...
Well, the thing is, not every vote counts equally, right? So you actually have to back your vote by money. So basically, if you're an expert and you are 100% certain that it will not open, you will find the money and you will put it in the market to just to make the benefit, to gain the proceeds from other people who thought it was going to open.
Yes, well, as an expert, I will be the winner, but as country Brandenburg,
you lose the $20,000 that you put in initially. But you actually gain the information that your airport is in serious trouble. And to basically, if you actually look at the running costs of an airport not opening, the $20,000 is absolutely worth it to you. Yes?
I understand the principle. You could do this on all kinds of databases. What's the advantage? I mean, you say Ethereum is not very practical. It's too expensive. So what's the advantage? I mean, it was great to raise money, but what is the advantage of doing it on the blockchain?
The advantage of doing it on the blockchain is that, first of all, you can get multiple players to pool their resources on the same platform. Secondly, it's not going to be censored. It doesn't really belong. It belongs to no one, so it belongs to everyone. I mean, that's the truly magical thing about the blockchain. And thirdly, we're working on the scaling solution, and I'm absolutely confident that we will figure those out. I'm almost done, right? Okay, my time is up, I think. Okay. Okay, cool.